This is Fintech Insider News. This week, global fintech investment is on the rise. Noah and Nala partner for cross-border stablecoin payments, and is a 10% interest on US credit cards imminent? We'll be tackling all of this and more on today's news show, so don't go anywhere.
I had that dream again. My small business needs to hire, but I don't use LinkedIn and I hire wrong. So our orders get all backed up. We're drowning in paperwork, then actually drowning, careless fighting off sharks with a stapler, and pirates are pillaging the office copier, and then I wake up.
Don't let hiring nightmares ruin your dreams. LinkedIn Jobs' new AI assistant goes beyond the resume, using unique insights to deliver a smarter shortlist. Post your job for free at linkedin.com/quality. Start hiring today with LinkedIn.
Hello and welcome to episode 1030 of Fintech Insider News, brought to you by 11FS, the 5-time consultancy of the year that works with financial providers big and small to build the next generation of financial services. I'm Laura Watkins, Director of Media and Marketing here at 11FS, and this week has been a busy one. We're barely into January and we've already launched a research report in partnership with Seckle all about embedded investing, which we can tell you more about in due course, and we're also kicking off with our event strategy, more announcements on that as we get into it as well. So it's been a busy week, but it's Thursday afternoon, and I'm very excited to have this conversation with our guests. So, as I said, we're barely into 2026, and fintech is wasting no time. There's plenty of stories this week from across financial services around the world. So joining me to help look past the headlines is our panel. So let's meet them. First up, a warm Fintech Insider debut for Matthew Goldman, founder of Totavi. Welcome to the show, Matthew. Please tell our listeners a little bit about yourself and Totavi.
Thank you. It's a pleasure to be here. Matthew Goldman of Totavi. We are a small fintech implementation advisory firm based in the United States. We help companies large and small to build primarily card payment products, credit cards, debit cards, disbursement cards, et cetera, and other embedded finance. And I've been in the fintech space my whole career building card products. I also write the Cards for the Win newsletter, covering everything to do with cards in the US.
Amazing. Thank you. And then, that deep card knowledge is going to come in handy as we get into our first story. So excited to get your insights there. Next up, we have Shah Ramezani, founder and CEO of Noah. Welcome to the podcast. You have some exciting news that we'll get into shortly. But before we do, please, can you tell us a little bit about yourself and about Noah?
Yeah, so I'm the founder of Noah. We are a stablecoin infrastructure company. So we provide our infrastructure for fintechs, modern neobanks that are building on stablecoins, and payroll companies. We basically see in stablecoins a modern way of moving money more efficiently. And excited to talk more about it in this podcast.
Fantastic. Well, thank you so much for joining us. And last but definitely not least, Veronica Glab, Strategic Partnerships Lead at Juice. It's great to have you back on this show. How has your start to the year been so far?
Also, a really good way to kick off a busy year with you guys. We're pretty busy on the Juice team. We just announced the expansion of our SME lending products from covering just that non-dilutive growth capital for consumer businesses to covering all types of working capital for different industries as well. We're going to be launching a few more products and some news later this year. So definitely a busy start with this one.
Awesome. Okay, so we have a panel. Let's start with our first story. It felt like there was a lot going on this week, but one story in particular dominated our social feeds, which was Trump's plan to cap credit card costs and the impact on bank shares. So the story was on BBC and various other places. Trump says he wants a 1-year cap of 10% on US credit card interest starting on the 20th of January 2026, which, if you're listening to this podcast on the day it comes out, is literally tomorrow. But it's unclear how it will be enforced. Bank and card company shares fell on the news. American Express fell around 4%, and Visa and MasterCard dropped by more than 2%. Industry groups warn a cap would reduce access to credit, with banks likely to cut limits, close riskier accounts, and trim rewards. With average US card APR around 20% is a big consumer-facing headline, but any move could face Congress and/or legal challenges. So, Matthew, our card expert, you called this a devastating for both the industry and consumers who rely on cards for flexible financing in a LinkedIn post. Can you tell us more about your kind of position on this and kind of why you think that?
Absolutely. Thank you. It's classic Trump craziness, policy by tweet or whatever he uses. I think there's a lot of skepticism that it will take place, and certainly in such a short time period. But I think the reality is that APRs represent pricing of risk. And I think there's a lot of nuance being lost in, averages as well. Like there are cards that are 10% and there are cards that are, 30%. And I think it's totally valid to have a conversation about usury and very, very high interest rates. But if you cap credit cards at 10% in the current macroeconomic, interest rate environment we have, they really can't work very well, right? Like you have a prime rate in the US that's a little over 6%. You have fraud and losses that are 3 to 4%. You have operational costs. You have rewards. Like you do that math and the math doesn't math, right? You're over 10% as it is. And so why would a bank or any lending institution want to lend money when they're not going to make money? They will lend that money in some other way. And consumer finance is so much kind of the analogy of the squeezing of a bubble or a balloon. If consumers who are high risk can't use a flexible financing tool like a credit card, they will find something else and they will go to payday lending or, some other high interest rate solution. And that's actually worse for them. And it's a challenge for the banks who have to, trim what has been a very profitable business. So could banks charge slightly lower APR and make money than their current average? Absolutely. And I'm not arguing otherwise. But a pure cap and for 1 year and just all the legal and operational implications, we all know if you ask a bank to make a big change, it takes them more than a week to do so. So it's just a complete kind of crazy approach. And I think would be bad for consumers and it would be bad for banks because they would not be able to manage the change very well.
On that last point around managing the change, theoretically, as listeners are listening to this on Monday the 19th, this is supposed to come into play the very next day. Like, how likely is that to happen? How long do these things take to actually get regulation in place? Is or was that ever realistic?
I don't think it ever was realistic. I don't think anything's going to happen on January 20th. I do think this could be a form of a trial balloon. Like, I don't know if this was discussed on this podcast, right? But a couple months ago, he was like, let's do 50-year mortgages. And everyone was like, well, that's a terrible idea for all these reasons. And then that went away and we didn't hear anything else about it. So this could be kind of testing the waters, which is part of how Trump approaches things. I don't think in the US, the president has the authority to create a national interest rate cap. It's not even clear to me that Congress does. They may be able to regulate how our national banks charge interest, but we have a lot of state banks that do lending as well. And some of those states, like I live in California, we have our own usury limit. It's a little more flexible, right? It's a fixed amount over a prime rate, which I think makes more sense. So it's unclear you can actually implement it. And then there's a really interesting constitutional challenge here, which is you could potentially say, well, on new balances, new purchases, you can't charge more than a certain amount. But if you make it retroactive, it could violate our Fifth Amendment and our takings clause, which means that the government is taking profit or money from private entities and individuals. And so I think it'd be mired in legal morass for well over a year, let alone this 1 year period that's been proposed.
Okay, so there's a lot of hurdles to this.
A lot of hurdles.
I like your point around it sort of almost being, sort of a theatrical play just to see what the response is, to see it like almost like a focus group with the whole world essentially, to see what the pushback is. Is there anyone that's like for this, to your knowledge?
I mean, it's been really interesting to see. I've had such lively online conversations, and certainly there's a good case to be made that 20% is a very aggressive average APR. And I think there's 2 points that do follow that and people pushing back against the averages. One is the U.S. Federal Reserve has done extensive studies on this, and they believe that in their kind of research, that credit card companies are effectively able to charge 1% to 2% higher interest rates than kind of prescripted by the loans they're making and the risks they're taking because of the marketing and rewards power of cards. And I think there's also, an argument that the complexity of credit cards, the way they're open and revolving, and they have compounding interest is something that can, cause people to be taken advantage of. So again, I'm not against any reform whatsoever, but I've been surprised to see how many groups across the board are coming out against it, not just banking groups, which sounds obvious, right? Banks protecting their interests, but also folks who have been in the financial inclusion space have said, look, this would be bad because it would take away a tool. And again, that might cause people to go to more predatory lending. If every consumer loan in America was limited to a certain percentage point, then maybe you wouldn't see that. But like, it's trying to, this is maybe a rough analogy in some sense, but it's like you can make drugs illegal, but people still want drugs. You can cap, loans, but people still need money, right? People are going to find a way to get the thing they need. Maybe they're going to end up at pawn shops, payday lending, et cetera. And so even the financial inclusion folks are really not for it. Although I think it is sparking a good conversation about what is a reasonable APR and, are there better ways to service consumers?
Mm-hmm. And then one of the sort of most well-known voices, I guess, who has spoken in favor of this is Klarna's CEO, Sebastian Siemiatkowski, who said that traditional credit cards embed inequality and that a rate cap could level the playing field. Shah, what was your take on this, kind of working in a different side of payments to credit cards?
Well, I think buy now, pay later doesn't remove the inequalities. It's pretty much repackaged it. So I understand why he's excited about it, and because it just basically needs more migration to other less regulated products, and I think to which Klarna will benefit. But yeah, I think generally, where this tweet comes from probably has a good place and a good part. I think I'm pretty sure if you look down the line, how credit cards make money is mostly, I don't know, I would guess that late payments and kind of like, use certain tactics whereby people might get basically might be miscommunicated or not aware of certain things. And I think maybe those areas can be targeted. But yeah, I think I pretty much agree with Matthew that, just reducing the cap will just basically means that a lot of credit card companies have to cancel certain customers or certain risk profiles. Then in that means that people probably will use other products like buy now, pay later. So it's not really like solving the problem. I think the problem is more that I know that these credit card companies also use certain hooks to get customers, and then there are other ways where they make a ton of money. And I think that's maybe there should be some guardrails around that. I think the European Union is pretty good at that. I'm not sure, but I know that they're very good at like capping certain things. Like for example, interchange is already capped or like has a bit of a capping. I think the US is pretty much pretty high. So I think it comes from a good place, but it's like it has to be more surgical. I would say.
Otherwise, yeah, to your point, if they're just putting a cap on, the problem still remains. It's just going to be moved somewhere else to a different type of product.
I think there's a great point there that Shah touches on, which is fees. And like we kind of use a general broad rule that when you look at a credit card revenue stream, a third is interchange, a third is net interest margin, and a third is fees. And so if you cut that interest margin, you're going to see higher late fees. Ironically, the Trump administration killed a late fee cap that would have moved it down to $8, and it's often up to $41. And annual fees and other things. So like banks are clever; they're going to find a way to make their money.
Yeah, absolutely. And there's a stat here also that says the average American is currently carrying $6,500 roughly in credit card debt, which is mostly carried by Gen X, sort of 45 to 60-year-olds, where this rate rises closer to almost $10,000. There's a lot of people relying on credit card and in a lot of debt already. Veronica, what was your take on this one?
Yeah, I think this one's really interesting to see what the user behavior would look like if this new regulation passed, because there's such a generational divide between the financial products that are being used. Gen X being much more dependent on credit cards, millennials kind of sitting in between, and then Gen Z more and more using buy now, pay later products. So the stratification actually is something I think would be really interesting to look at from over a long-term period. What I do also find interesting there is that the difference between like buy now, pay later products and, and credit cards is one thing we haven't touched upon yet, which is that credit cards give you a credit history. That's really rich data that will help consumers eventually make some of the most financially important decisions of their life, like buying a car, buying a house. That's something that Gen Z is maybe not understanding quite as well, that the importance of a credit history and how that can impact your financial wellness over time. So I'm not going to defend the morals of one particular financial vertical or another, but the traditional credit products are still a much more useful tool beyond just offering financial leverage and cash flow for making of purchases. It's the credit history over a longitudinal period that's really important to watch. And that's why I think it'll be really interesting to see how different generations use different products to plan for their financial wellness.
Yeah, that's such a good point. And I think, there's a lot to say around this one, and I think we could probably talk at length, but I will have to move us on. However, before I do, I just wanted to ask you all a quick fire question. Do we think this actually happens? Yes or no? 10% credit card rate cap applied. Yes or no, Veronica?
No.
Shah?
No.
Matt?
No.
You? Sorry.
No.
Okay, so you are in agreement with our community, who we also polled, and our community were divided, shall we say. 81% agreed with you, they said no, and a few optimists, the 19% said yes. So we will see as this one pans out how right the majority is over time. We're going to move us to our next story, which is that Noah and Nala launched instant stablecoin settlement network to modernize an $850 billion emerging markets payments. This story in fintech finance. Noah and Nala have partnered to use stablecoins for cross-border settlement, initially targeting Africa and Asia. Businesses will be able to collect USD and pay out local currency in minutes, not days, with cost reductions of over 90%. This should solve an estimated $850 billion liquidity gap and help firms manage FX volatility via USD virtual accounts and instant payouts. Nala says it's already moved $1 billion in 18 months with its Rafiki infrastructure platform scaling rapidly and serving clients, including MoneyGram. So, of course, Shah, makes sense to come to you first. Firstly, congratulations on this partnership. For listeners who are perhaps unfamiliar, could you maybe dig into this a bit more, make it real for us? What kind of real problem are you guys solving, and why was this partnership necessary to come together to solve it?
Yeah, so basically, I think it's a very stablecoin has been a growing trend the last few years. Of course, sending stablecoins around it's fast. It's I always make the analogy. It's like the telephone over IP. You basically circumvent the telephone networks and just use a protocol to send a message. But in the case of stablecoins, it's not only a message; it's also settlement of the asset at the same time. What has been missing is having the connection to local ramps, because at the end of the day, if you are sending money, let's say from US to somewhere in Africa, you would expect to receive a local payouts, so like local currencies. I think we are working with a number of banks, number of payment companies, whereby we are able to enable global money movement by using a combination of stablecoin and local payment methods. And Nala has been our partner of choice. They are a very strong on-the-ground partner who have, I think, over 17 or 18 licenses in different African jurisdictions. So we build a partnership out to enable our clients and their clients to be able to complete that payment from these corridors, US to Africa, Europe to Africa, which have been previously a challenge.
Amazing. And so kind of tell me more about that. We sort of mentioned that $850 billion liquidity gap. how does that come about, and sort of why is cross-border payments in the regions that you're choosing to partner with Nala in still such a pressing issue to correct?
Yeah, so I would say there is a number of issues. One is that corresponding banking doesn't work really well in those jurisdictions. So, I think it works well, Swift payments from US to Europe. But when it comes to like really local African markets, it becomes a challenge, and there is a liquidity issue. Plus, there is also a time speed issue, and there is also a cost issue. So, if, for example, if you send a US dollar and you want to get it paid out in bank XYZ, you're often, you can only do the FX change with the bank. So you don't have much options. So on, you have a liquidity issue, you have a speed issue and a cost issue. The good thing about stablecoins is that you don't need interbank payments anymore. So the way US dollar moves to stablecoin in the US would be through local payment methods, so ACH and wire, which are pretty instant and fast and cheap. And then once you're on the stablecoin network, you are able to settle anyone instantly. So you basically can settle your counterpart, let's say dollar or in stablecoins, and then they will be able to make the payout in local currency. So you're moving money without actually going to the Swift network, which is quite exciting and fast. The last 10 years, the trend we've seen is that in every part of the world, we have now local payment methods. So let's say SEPA in Europe, you have instant payments in UK, you have now FedNow in the US, you have UPI, you have PIX, and also in Africa, you have mobile money and a lot of different payment networks. And if you combine that with stablecoins together, you can move money pretty much instantaneously. So that's kind of the unlock is really the speed and the efficiency that brings more value to the market.
Amazing. And then equally, when we were researching, there's something that you said stood out. The emerging market digital payment space could exceed $1.5 trillion annually by 2030. Is that growth being driven by all the things you just said, sort of the speed and the efficiency?
No, I would say it's also driven by the digital economy that is growing. So you have marketplaces, you have more freelancers, like a lot of the people in the world are able to participate in the global workforce without actually relying on the government. You have a lot of engineers, freelancers, a ton of people. But historically, payment has been a challenge. And I think that challenge is kind of getting solved and moving away, and it becomes faster and cheaper. So I would say just the immense growth that it brings to for all these people in those markets to participate in the economy. Before, I would say you were kind of locked out. Why? You didn't have, let's say, internet penetration wasn't high. I mean, now it's an all-time high. Everyone has a smartphone. Everyone has a laptop. It's like almost like a public good. So you can participate, but now you also have the payment rails. And you have to imagine, let's say you were somewhere in Nigeria. Most people don't even, actually Nigeria is quite well banked, let's say another country, but people don't even have bank accounts because they don't want to bother go to banks. But with stablecoin, they can either open local payment methods or actually just basically have a wallet. They can issue a wallet, and anyone can issue a wallet. It's like issuing. It's like a function in the software world. And then as soon as you have the money, you can either go to your local person, like your kind of your local MoneyGram, like your shop, give them stablecoin, get cash. So I think. We see this unlock whereby the entire workforce there is able to participate from a economical level. Yeah.
Okay, amazing. So it's like a huge enabler for other sort of parts of the economy that were maybe excluded.
Exactly.
Fantastic.
Yeah.
Veronica, I want to bring you in. Obviously, you've been on this podcast quite a few times, and I'm sure you've heard us. We've debated around cross-border payments being slow and expensive, fragmented. Increasingly, we're talking a lot about stablecoins. Is cross-border payments kind of like the killer use case for stablecoins? What's your take?
Yeah, I certainly think it could be, especially when we're looking at emerging markets. So part of the reason, some of the factors we've already covered, it's not just cheaper, it's not just faster. Like we're already seeing the success metrics behind that. But I think there's two pieces there that are really interesting to dig into even further. At the sort of individual or smaller, like small business level, it has a tremendous social impact because it can help individuals and small businesses really hedge against inflation. And that actually really, really matters, even if we're not talking like multi-billion dollar or pound level figures. So the social impact, financial inclusion part of it is always really exciting for me. But then at that larger scale, it's also the traceability. So traceability, it's always going to be really great for de-risking, for auditors. And when you're talking about big enterprises or governments making transactions, that's when I think we'll also see further pickup as well.
And Matthew, coming to you, maybe on the other side of the partnership, we'll talk about Nala, which has already moved $1 billion in 18 months, working with MoneyGram, those sort of local payment providers as well. What's your take on that? Should banks be looking at them with a bit of fear? Should they be threatened by that sort of scale, or actually is this a world where kind of everybody wins and you can work together?
I'm sure banks do feel threatened by change, but I think they should look at it as a place where you can win. I think something Shah touched on that's a really important point is that stablecoins are messaging and money movement, and a lot of traditional systems are really just pure messaging. And so you get certainty and speed and lower cost and a lot of benefits. And as the world continues to globalize, as companies hire employees in all sorts of different jurisdictions, like the ability to pay people, move money quickly, move it efficiently just continues to grow. I think that market grows for everyone, right? So there's an increasing size of the pie, and banks should be able to compete by saying, how do I provide better service? And using stablecoins as part of their strategy will help them win, an increasing share of an increasing pie. So I don't think they need to be threatened, although I am sure some bankers, would like things to stay the way they are.
But that's awesome though. So sort of in a kind of like rising tide lifts all boats. Like everyone could benefit from the sort of stablecoin boom. Is that what you're saying?
Yeah, absolutely. I mean, I think there's just more international commerce, and it's in all scales. To Veronica's point, it's not just multinational corporations making giant purchases, but you have companies hiring freelancers or employees all over the globe, and they need to move that money around. A big area where we worked on some stablecoin projects is, U.S. companies paying contractors all over the world, and then those contractors need to buy U.S.-based services, or you can put in any two sets of countries here you like, but it's very different from the old world of I have subsidiaries and I'm a corporate treasurer and I move money here and there, and stuff kind of filters through the local systems, and it's much more interconnected.
And Shah, coming back to you, I want to give you the sort of final word on the story. What's the kind of most exciting thing about this partnership to you? What should like the key takeaway be for the listeners?
I think I think Veronica already touched base on that. I mean, I think the biggest opportunity we've seen why stablecoin is growing so fast is previously it was very hard to give dollar access to emerging markets. Like it was pretty much non-existent, and it's kind of interesting because we try to understand why that is. And really, so creating dollar accounts and also giving dollar exposure with stablecoins has been really a push from crypto. Previously, it was not really being pushed towards banks. And what I understand, working with a lot of banks, is that simply they don't want to do the compliance work. For them, we had a number of occasions with let's say EMIs or banks whereby the argument, they're sitting in Europe and they really believe that in Africa everyone is fraudulent. That's how, I mean, most of them I assume have not traveled. So I think stablecoin, given that it has grown so fast in those jurisdictions, it has shown and has helped us to build a business case for a lot of these fintechs and banks that this is a huge market, and a lot of these participants want to basically hold dollars and foreign currencies. But because before you could only get local, so on international rails it's hard because with SWIFT you could not, because the bank in local in the local would basically intercept because they want to fight against capital flight. But given that you can give them local rails in the US, let's say ACH Wire or like SEPA, in conjunction with stablecoin, you're able to actually give them international payments. And I think that's the biggest exciting news. You have to imagine a lot of these people are not particularly poor because they don't work hard, because every time they save their money, they put it in an asset that loses value constantly. And it's a big, and previously they were solving that problem by putting hard cash. I'm talking about like dollar notes under the pillow. And I think that solution is not needed anymore. So I think that's pretty exciting news. By the way, for businesses as well as consumers, like it goes from both sides. Yeah.
Brilliant. Well, yeah, congratulations on this partnership. It sounds like you're on a real roll with lots more to come and a huge opportunity space in front of you. So please do come back and tell us more about it as it unravels. On that note, we're just going to take a quick pause here. Back shortly.
Hey folks, if you're anything like us, you're on the road constantly. Airports, hotels, conference centres, half the time the Wi-Fi feels as safe as shouting, "My PIN is 1234" across the departures lounge. That's where NordVPN comes in. One click or no clicks with AutoConnect. And suddenly, every sketchy airport network becomes a whole lot safer. You still get blazing fast speeds and 8,700 servers in 129 countries, so you can switch your virtual location while you're waiting for yet another delayed flight. One account covers 10 devices, and you get Threat Protection Pro to block malicious links and ads, plus Dark Web Monitor if your details show up where they shouldn't. We've teamed up with them to offer FinTech Insider fans an exclusive deal. Head to nordvpn.com/fintechinsider to get a huge discount and 4 extra months on top, completely risk-free with their 30-day money-back guarantee. Links in the description.
Now, a quick break from the headlines to let you know about something exciting we've been working on here at 11FS. We've teamed up with Seckle to produce a brand new report on the future of embedded investing and the huge untapped potential for brands and consumers. Get your copy for free right now via 11fs.com/embedded-investing, and we'll put a link in the show description as well. And now, back to the news. Our next story is that Wio Bank launches first account for content creators in the UAE. A story on MSN. Wio Bank has launched the UAE's first banking account designed specifically for content creators and digital entrepreneurs, offering tailored features to support income management, payments, and business growth. Wio Bank said the account enables content creators to work efficiently on a global level and gives them true financial independence. The account is fully digital and multi-currency with no minimum balance requirement and offers smart tools that enable users to manage bills and business operations easily without the need for an accountant. To find out more about the launch, we spoke to Amina Taher, Chief Marketing Officer at Wio Bank. Let's hear from her now.
At Wio, our ethos is built around empowering both individuals and businesses to be able to spend, save, and invest smarter. And content creators are one of them. So we sat with them at the 1 Billion Summit last year and listened to their challenges. And honestly, their feedback was consistent. Everyone said one same thing, that their bank account doesn't get them. Whether, invoicing was manual or being paid across borders was too complicated and so on. So what we did is we came back this year and we took those conversations and feedback and we created Wio Creators. Wio Creators is the first UAE bank account that's built specifically for content creators. What does that mean? It basically gives them 12 months of free banking, fully digital onboarding with no minimum balance. You've got built-in invoicing, smart reporting, and multi-currency account. And this was all designed to remove friction so they can focus on actually creating and growing and continuing to build impact in their respective field and contributing to the creative economy. So we're incredibly proud that we launched this with Visa along with Creators HQ at the 1 Billion Summit. And so far the feedback has been great, and we hope to continue to evolve this product for the content creators here in the UAE.
And thank you so much to Amina for sending that through. So, is it significant that they have pointed this product at content creators rather than gig economy workers or freelancers specifically. Veronica, what do you think? Is there sort of a difference in terms of the needs of content creators and versus any other form of gig economy work that would require their own specific bank account?
Yeah, I mean, I think this does feel like a very Dubai UAE story, but there is a reason for that as well, which is that there's certain needs that these two different economies, or they'll overlap, and then will there be quite different. So where they'll overlap is potentially in the fluctuation of their individual income. So gig workers or content creators may have a certain seasonality of their jobs, that might vary by day, by week, by month, or by season, depending on what it is that they do exactly. So you're going to have certain banking applications that will fill these two economies with a certain level of overlap. But they are quite different because gig economy typically tends to be very transactional, high volume, lower margin, a lot of physical tasks that are better equipped for certain types of platforms to handle that fluctuation and that kind of behavior, and then the financial needs that come on top of that. Whereas the creator economy typically will be lower, low volume, but sort of high value partnership as well. And they're just going to have very different financial needs as well when it looks at cash flow, eventually if they ever have to take out a loan or any other sort of financial service as well. So this seems, for me, actually very of the moment, particularly in the UAE, which is a very creator-heavy economy as well. They're quite well positioned to take that on, and I'll be really keen to see if they end up expanding that to any other markets where there's a heavy creator economy.
Yeah, definitely. So the significance of the launch was that it was at the 1 billion followers summit, which was, quote, the world's largest gathering dedicated to the content creation economy, which was organized by the UAE government's media office. And equally, the creative and creator economy is actively being developed as a pillar of sort of digital entrepreneurship in the UAE as it sort of grows its sort of digital footprint. And yeah, as you say, Veronica, it'd be interesting to see if that could be expanded either to other geographies or other niches. Kind of, Shah, I know, from what we were just talking about on your story, obviously there's a huge potential for kind of gig economy workers, people who are sort of outside of the usual kind of financial systems. What's your take on this? Do you think this works as an opportunity?
Yeah, I guess first of all, Dubai obviously is a tax haven. So I just was there for 6 weeks, and there is a lot of independent workers. I think it's a kind of a big trend whereby people have much better lifestyle. They can choose their hours. They work when they want to. Some of them don't work for a month, and then they choose to work for another 2-3 months. So I think it's definitely a growing trend, especially among the young population. They just want more flexibility in their life, and they avoid any of these traditional office jobs. So yeah, I think it's a growing sector overall. I think it's obviously the internet made that possible because you could basically make let's say YouTube video content creators, like all of that wouldn't exist without YouTube itself and the growing audience or TikTok. So it's definitely going to keep growing as the internet grows and more people are online, and basically creators are able to reach their target customers directly, and they don't even have to scale to millions of users. You can also have like a niche user base of 10 to 20,000 that is highly targeted. And now with AI, it seems that a one-man shop is going to be extremely powerful. So I would just see that trend accelerating in conjunction also with the lifestyle it provides. And Dubai is definitely the hub for that because most of these creators are also traveling a lot, and they're just going to be a few months in Dubai, and otherwise they're going to be everywhere under 6 months, and just benefit from the Dubai taxes.
Yeah, that's very true. And sort of seeing this almost as moving almost ahead in the evolution of how people will work and how their lifestyles will work and how they will want to manage their finances in accordance with the future of work, essentially.
Yeah.
Matthew, what was your take on this? For a bit of background on Wio Bank, they've been on a huge trajectory since they launched in 2022 with 250,000 retail customers, 120,000 business customers, and an increase of 72% year on year from 2024 to 2025. And were very well known for reaching profitability in their first year of operation. Does this sort of stability, particularly that profitability piece, give them a good platform from which to sort of experiment with new products and services, try new things, try new niches? What was your take on this?
Yeah, absolutely. I think it's very interesting, regardless of geography, to see a chartered financial institution build this kind of product. We've seen fintech companies poke at this, some of which don't exist anymore and some which do. Like we have Carrot Financial here in the United States that offers business banking and business credit cards focused on creators and influencers. And I do think there's high value, generally speaking, in focused accounts for different types of businesses. And creators are a form of a business, but as Veronica noted, not a typical form of a business, perhaps. They have unique needs. And there's other factors like even financial education that can be built into these accounts to help these folks be successful. Like I noted that Wio mentioned, not needing an accountant, being efficient. So what are those tools? And it's very interesting to see a bank itself doing that when you think of them as being typically more conservative. And, these would be probably more challenging, micro or small businesses to lend to. But I think that Wio's base gives them an opportunity to kind of attack the problem from that level of stability in a way that, a startup trying to do this in a bank partnership would not be able to.
Absolutely. On that point around that sort of not having an accountant, but also trying to layer on financial education, is there any sort of risks or drawbacks to a sort of digital approach like this, either on like the immediate KYC side or in terms of like the customer support, particularly if they're new to like this sort of way of working, no branches, in-app support, no accountant, etc.? Or are these people digitally savvy enough that it shouldn't matter to them? What do you think?
I would imagine they love digital service. Maybe they're asking other personal finance influencers to tell them how to do their taxes. I don't know. Maybe that's the trick. But I do think, and we see this in a lot of geographies where there are fees on accounts like this, even if there are not necessarily minimums or other things, but there are kind of add-on services to go there. And to Shah's point, maybe AI is going to help people to, manage some of these things, because I think financial services always feels very personal, and people do want that customized advice and not something that's generic. Like you can say, save for retirement, like how much and in what form and what's right for me and all these things is a very personal decision. I think that's where we have yet to see automated tools really solve that problem. I think people still want personal advice for a lot of that.
Definitely. And then even the product itself on that kind of personalized angle, Wio say that they designed this product with direct feedback from its target audience, i.e. they spoke to actual content creators, kind of figured out what their sort of banking needs were or how they were not being addressed. Veronica, kind of how critical is that if you're going to create a product like this for a particular niche to actually have them work side by side with you to actually build that for their requirements?
Yeah, I mean, I think it's actually really critical, especially when you're building a digital first product. You want to have the richest possible data to ensure that level of personalization, the duty of care to the customer, and actually even be able to anticipate their needs so that your business can scale alongside their business. I think the personal touch of being able to go to a financial advisor, it's something that's absolutely crucial. So you have to replicate that in a digital only space, especially because going to a financial advisor means that someone has to be financially literate enough and proactive enough to approach them. But you can circumvent that by designing a proactive process that says, hey, customer, you've saved this amount, but do you know you can actually maximize your retirement savings by doing XYZ in the next 6 months? Or here's an opportunity to, change up your investment portfolio or your savings or your tax efficiency. There's that having that data and the richest possible data on consistent user behavior is what helps a business grow as their customers grow, both as people and as solopreneurs.
Fantastic. Well, we will keep an eye on this one and see how it evolves. If it goes to other geographies, if it goes to other niches, etc., we'll keep an eye on that one. But I'm going to move us on now to our next story, which is that global fintech funding surges 21% in 2025, according to a new Innovate Finance report. This story on fintech futures says that new research from Innovate Finance shows that in 2025, global fintech investment began to grow again, with an increase of 21% and a worldwide total of $53 billion over 5,000 deals. The US remains the leading market, with $25.1 billion, where the UK reclaimed second place by the end of the year with $3.6 billion, closely followed by India, who had 3.4. The payment sector was the major issuer of capital in 2025 globally and in the UK, with significant raises by crypto platforms in the US and the UAE. The largest primary raise of 2025 was Binance's $2 billion deal, which bolstered the UAE's ranking position massively in the first half of the year. So Veronica, I want to come to you first on this. What were your key takeaways from this report? And obviously, aside from those sort of headlines that I read out, overall, is this good news for the fintech sector?
Yeah, it's a good question. In some ways, I almost want to say it's not entirely news, because this actually points to fintech investment stabilizing. Back in 2021, when we had the peak of investment at over $100 billion globally, that was such a massive piece of news. And those figures globally seem to be stabilizing in terms of the amount of capital that is being invested. So that 50 odd billion actually feels like a healthy amount from year to year, moving away from a fintech bubble. So I kind of see it as a no news is good news. It means the sector continues to mature. There's steady growth. There's new verticals and new ecosystems to invest in, new niches that go deeper and deeper and continue the maturation of the industry. And there's a few headlines in there that I thought were quite interesting as well. I mean, the UK has always been a pretty solid number 2, but it is interesting to see other markets start to catch up with that in terms of the volume of capital being invested in those markets. And for the last few years, we've seen where the sort of global top 10 markets used to be really concentrated in North America and Europe is now really spread across continents. So I think just another indication of the maturation of the industry, but also emerging markets catching up.
Yeah, definitely. That was really nice to see. And I think overall, there was almost like we reported on this at the end of the first half of the year where everyone was a little bit concerned because what we're seeing is a sort of 40-60% split in the year, in that there's a bit of a slow H1 and then it all sped up in H2 to get to that kind of 21%. But you're right, the global top 10, United States, UK, India, UAE, Singapore, Brazil, Canada, Mexico, France, and Germany. So as you mentioned, like a huge spread geographically. Matthew, if I bring you into this one, is there any surprises on that list in terms of the kind of points Veronica made around like some emerging markets growing in stature?
Yeah, I don't think so. I think that what I find funny about these reports is the focus on pure capital volume. And you talk about things like Binance, like these outliers that can really shift the country in one place or another, as well as there's this kind of counter-indicated trend going on. So if you look over these reports of the last 3 years, you see the recovery in total volume, but of dollars invested, but a decline in total number of deals. They reported in the same set of studies over 7,600 in 2023, 6,400 in 2024, and 5,900 in 2025. And so I think part of the mixed message here is kind of more money going to the top, right? Those 500 million to multiple billion-dollar deals. And not only can they shift the country ranking, but also they're really focused on growth capital. And what concerns me is, where is the next generation of companies coming from? Because those more smaller deals, which may be occurring in emerging markets, those are tomorrow's big players. And if you don't have that seed capital going on, where is this going to come from? So I'm kind of watching that other part of the trend as well, and seeing, are new companies starting in new markets? Are we getting new markets involved? We're getting net new companies involved, or is everyone just throwing money at the biggest players in the space? And obviously the kind of shift in regulatory environment in crypto has really accelerated that, as you mentioned, the second half of the year. But there's other things that need to be invested in, and I'd like to see more of that.
Yeah, absolutely. You can't keep throwing money at the same companies, otherwise the smaller ones just don't get the same start. Interesting that payments is the biggest sector for funding. I think that's been fairly consistent for the first few years, followed by infrastructure and service providers, rather than direct-to-consumer offerings. What do you think we can read into that, Shah, sitting in that space yourself?
Yeah, I mean, I think, I guess, like you had the first level of fintechs who had to build everything themselves, and like the likes of Revolut, and now we are seeing, literally Revolut applications being built on some of our infrastructure in very fast time. So I think that makes infrastructure obviously be exciting. A lot of that is now possible as you can, regulatory clarity. Banks are more technology driven. And I think could also be that people don't know where the market is moving, but they know that infrastructure is winning. So why don't we fund that and then kind of observe where the apps are being built? But I'm pretty sure at some point also the apps and they will also be quite exciting. But also I think with AI, obviously the question of what an app is changing. I think the interface, how we are going to deal with applications is going to change over the next 10 years. Be it voice, be it speech, voice, speech, or text. No one knows, but I think it's definitely like a fast moving space right now. So I think it seems like infrastructure is the right bet. And I think for a lot of these investors, it's kind of also good to know when you invest in infrastructure, you see also who is building on top of them and kind of where the market is heading.
Yeah, absolutely. And you mentioned Revolut there. Veronica, I know Revolut is a company you're always keen to discuss. Revolut's sort of role in bolstering these numbers is sort of full, via that $3 billion secondary share sale, which was the biggest example of a secondary share sale in 2025, which was a kind of another method to get capital that really kind of took off in 2025. What can we read into that? And is this sort of a way of almost delaying IPOs, or is there more to it than that?
Yeah, I mean, there's two things there that are also quite interesting. I mean, a secondary share sale, it's a different type
It's hard
of
to say, right?
It's a hell of a tongue twister. A secondary share sale is a different type of investment than a pure, Series E equity deal. So I was surprised to see it included in the global total for the amount of capital invested globally, whereas the rest of the deals seem to be mostly equity based. But what this says about Revolut is interesting, and it does indicate that they're smart and they're strategic. This is a really great way to get a big injection of capital because they're at that stage of growth where they're going to need such an outsized amount of funding that another VC round is not necessarily going to cut it anymore. But if they go on the public market, they would be faced with such a level of, scrutiny and regulatory overhead, and then shareholder, facing scrutiny as well, that maybe they're not that quite ready for it in today's particular climate. So if they can delay that by a few months or maybe even up to a year when it looks like it's going to be a more favorable market for them and when they can get through that scrutiny more breezily, let's say, then they're going to do it. I think it's a strategic move on their part and potentially quite a smart one given the current climate.
And if, imagine we're a year from now and Innovate Finance are compiling this report all over again, looking at the funding landscape of 2026. What do you think would be the key takeaways? Do you think it would be dramatically different from this year? And sort of where do you think the changes would be? The geographies, the amounts, the niches that are getting funded? I realize I'm asking you to predict the future here, but what's your thoughts?
Yeah, I think there's a few things that would be interesting to watch out for. Matthew already touched on it, as well as the geographic distribution, because the outsized deals can really shape how a market, how a country shakes out on the global stage. And then there's always a few countries, China, Mexico, who tend to be quite turbulent, where one year they'll show up in the global top 10 and the next year they can be at number 20. So it's always interesting to see the global distribution. Definitely think that will change. I would be really interested to see what is happening at the Series A, Series B investment levels, because it looks like seed level investment was fairly healthy. But what I want to know is what's happening at Series A, B. Is it that the companies who are applying for those funding rounds are not getting funded because their business model or their product isn't solid enough? Are they being acquired by one of their competitors or some of the big unicorns like Stripe or Revolut, who are using their technology? So I want to know what's happening there.
Okay, well, lots to look out for, and I'm sure we'll have you back on throughout the year to kind of keep an eye on those things, and we'll be having this conversation in a year's time, I'm sure. But on that note, we're just going to take a quick pause here. Back shortly. Okay, now for a quick look at one story we don't have time to cover in full, which is that Nationwide fights back against scammers with a checker tool to highlight dodgy phone calls. This story was in This Is Money. Nationwide Building Society has launched a scam checking tool which will tell customers if they are on the phone to a genuine Nationwide employee or a scammer impersonating one. If a customer receives a call from someone saying they are from Nationwide, they can now use the call checker located in their banking app to check if they really are from the Building Society. The tool comes as customers are being plagued by 8 scam calls a month on average, 17% of reported scams, and scammers stole £65.9 million in 2024 through impersonation scams, according to banking industry body UK Finance. In the same week, Revolut has also launched a very similar tool on their app, joining the likes of Starling and Monzo, who launched their own last year. To get some expert thoughts on this, we heard from our head of product over at 11FS Pulse, Joe Colchester, to find out more.
Yeah, so this is a really encouraging announcement from both Revolut and Nationwide, following on from the footsteps of Monzo and Starling, who rolled out this feature before. It's great to see this becoming a traditional UK feature now across banks. I know there's 4 of them, but I'm sure it'll be rolled out more as customers ask, hey, why don't I have this? Why doesn't my bank have this? It's very, very helpful because it intervenes at the point of vulnerability. It's context-aware UX, and it comes at a very important time where AI technology is on the rise, deepfakes are on the rise, and scams are higher than ever, especially impersonation scams. So it's staying one step ahead, and it's a feature that all banks try and include if they can.
Thanks so much for that, Joe. And we will be keeping an eye on that and see if many others also start to roll out the same feature. It seems to be a very popular one at the moment. And I'm going to take us now into our And Finally section. One more fun story you might have missed this week, but we think deserves a shout out. And that is that Monzo are giving away Coventry City FC football shirts for 1p or 1 penny to encourage responsible saving. This story on the Coventry City website and other places. For our listeners who may not be aware, Monzo are the principal sponsor of English Championship League men's football side Coventry City FC. Ahead of this Saturday's match and in conjunction with Monzo's 1p Savings Challenge for 2026, Monzo will host 2 pop-up shops in Coventry where supporters have the unique opportunity to purchase the official away shirt for just 1 pence when they sign up to Monzo. 1 pence is the start of the Monzo's 1 pence saving challenge launched this January, where customers can save 1p on day 1, 2p on day 2, and so on until day 365, when you should have saved £667.95. The campaign with Coventry City is to prove how much impact a single penny can have and how easy it is to build lasting savings habits and turn small daily savings into something big. So, what were your thoughts on this? Maybe coming to you first, Matthew. Is this a good example of a brand partnership engaging new audiences, doing something positive? What do you think?
Yeah, I think it's super fun. I love micro savings approaches. I think we've seen a lot of success with them with roundups and micro savings. It's hard for people to get started, but once they see the power of compounding interest and regular savings, it can be really, really powerful. So I always love, companies that are trying to do things here. I was curious, football is a very serious topic and people have very serious feelings about their team. And so is picking one team a problem for Monzo? Does it turn some people away? But I did think it was a fun approach and definitely excited to see how it turns out.
Yeah, definitely. Shah, what were your thoughts in terms of this sort of attracting new users, new savings habits, and making it feel achievable, starting with something so small as a penny and watching it compound throughout the year? What's your take on that?
Yeah, I guess they are very much closer to their audience. I think Monzo has obviously a different audience than I would say Revolut. Everyday user, more simple, and I think a lot of them probably are also, I would assume, they watch football. And I think it's kind of a new way of doing it. I think it's better than just spreadsheets or any other like rewards. I think it seems a little bit more real, and I'm sure it also creates a bit more people talking about it. So
yeah, absolutely. I think that brand partnership play is really good. Obviously, you get a lot of these sort of fintech and football partnerships where you're just the shirt sponsor and then it's kind of all the brand does in a way. I think kind of actively getting out in the community and attracting a new audience who are tangential to the brand because they're already a supporter of the football team and they're the sponsor. I think kind of bringing those two worlds together is a really fun campaign. Obviously, it actually hasn't happened yet. It's coming this particular weekend, so I think it'll be interesting to see what the uptake is. But yeah, Veronica, what's your take? Have you done the 1p challenge? Are you a Monzo customer or anything similar?
Yeah, I mean, you're really pitting me against my fandom across the different neobanks. But no, I think I love it. I think Monzo just always get it right in terms of understanding culture, understanding their community. Because they've done a few layers of really clever things here. Like the 1p challenge in and of itself is a really fun way to gamify compound interest and teach financial literacy. So they get that for their audience. They've also, gone outside of the London bubble. So many of the fintech unicorns really stay in big, in the London bubble, and they've gone outside of it. They've always been really great at representing the UK regions. And they've, done a really great brand partnership with another beloved brand. I actually remember being on this podcast maybe a year ago or so when Monzo had done their partnerships with Greg's, and you guys made fun of me for never having had a sausage roll, but it's like they just always get it right.
Have you had one yet?
No, I haven't. Oh, sorry. I haven't. It's a really bad addition for me, but I'm now going to put that on my New Year's resolutions, and I'll see how they do. Monzo do with this campaign this week as well.
Fantastic. Just as a final fun question, obviously this is Monzo sponsoring a football team. Are there any other brands, maybe from the markets that you're representing today, that you would like to see sponsor a sports team? Any sport, doesn't have to be football. Matthew, what would you say?
Yeah, I think it's a really interesting point that there are lots of financial services sponsors of lots of sporting teams, and it is the patch on the jersey. It's not the activation. So I would love to see more activations. One that I think is fun, SoFi here in the United States. The stadium here in Los Angeles is SoFi Stadium. And if you have a SoFi debit card, you get like access to a special line to get in and things like that. I would love to see them extend that to savings. I think that would be very cool. But I think it's going beyond the patch on the jersey and really making fans learn something is really cool. So I think here would have to be the National Football League. That is our largest sport. And there's just a bunch of logos today. That's all they've done.
Okay. Shah, what would you say? Who would you like to see sponsor a sports team?
I'm honestly I'm the wrong person to watch. I don't watch that much sports, so I'm actually not aware of who's doing what right now. So sorry, I can't answer you that well.
No, that's okay. Veronica, any thoughts from you?
I don't know, but I'd like to see some of the neobanks sponsor like really niche sports, like pickleball, paddle, something for amateur players. I think it'd be really cool to see that.
That's a great shout. They're also like the fastest growing sports as well. So like if you get in now, like that would be amazing. Like Monzo could be, sponsoring the entire league.
I don't know, maybe bring back highlights.
Yeah, that would be cool. Yeah. Obviously, Starling got in quite early doors sponsoring the Lionesses, the women's football team over here, who are fantastically successful. So that was a great one. Also very, very, very niche. But there's a Bulgarian tennis player called Grigor Dimitrov, who is sponsored by Payhawk, a Bulgarian fintech. And this is, the combining of my two worlds in that I'm a big tennis fan and obviously work in fintech, in that I was watching Wimbledon and noticed that his sleeve sponsor was Payhawk, this Bulgarian fintech. So from a personal note, I'd love to see more of that, just like slightly random fintech partnerships on sort of tennis players at Wimbledon. That would be fun. But maybe that's just a personal want. So I will wrap the show there. Thank you so much to today's guests. Where can people find out a little bit more about yourself and your companies? Maybe start with you, Shah.
So company is under noah.com, so NOAH.com. I believe the Twitter handle is Noah_HQ. My personal Twitter is Shah, SHAH, Ramezani, RAMEZANI. So Shah Ramezani, and same for LinkedIn. So it's just that handle, yeah.
Brilliant. Thank you. Matthew?
Yeah, thank you. It's been a pleasure to be here. I'm easy to find. Our company is Totavi.com, and you can sign up for my free cards newsletter at cardsftw.com.
Fantastic. Thank you. And Veronica?
Yeah, you can find out about Juice at getmejuice.com or just message me on LinkedIn at Veronica Maria Glab.
Wonderful. And as for me, you can find me, Laura Watkins, on LinkedIn, on this podcast, or on 11fs.com. And that wraps up today's episode. Thank you so much for listening to today's show. If you like what you've heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share the podcast with a colleague or friend? And as always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or you can email me and the team, podcasts@11fs.com. Thanks again, and goodbye.
Reggie, I just sold my car online.
Let's go, Grandpa. Wait, you did?
Yep, on Carvana. Just put in the license plate, answered a few questions, got an offer in minutes. Easier than setting up that new digital picture frame.
You don't say.
Yeah, they're even picking it up tomorrow. Talk about fast.
Wow, way to go. So, about that picture frame.
Forget about it. Until Carvana makes one, I'm not interested.
Car selling made easy. On
Carvana.
Pickup fees may apply.
Well, the holidays have come and gone once again, but if you've forgotten to get that special someone in your life a gift, well, Mint Mobile is extending their holiday offer of half off unlimited wireless. So here's the idea. You get it now, you call it an early present for next year. What do you have to lose? Give it a try at mintmobile.com/switch.
Limited time 50% off regular price for new customers. Upfront payment required. $45 for 3 months, $90 for 6 months, or $180 for 12-month plan. Taxes and fees extra. Speeds may slow after 50 gigabytes per month when network is busy. See terms.